When the going is good, you also must understand that things can change. Preparing for the change is very critical. What kind of preparation you need to do? Are you positioned correctly for the emerging scenario? Do you need to do something specific? To understand these things, do join us on this webinar and participate in it to prepare yourself better for your tomorrow in investing. Thank you very much. Friends, in this video for ITHOUGHTWEALTH, I am going to talk to you on the topic what ITC teaches us. Over the last 3.5 years, there has been an ITC movement. Everybody has hoped, believed, invested, waited, got excited, disappointed, and gone through all sorts of emotions on this roller coaster. What began as a hope trade is now slowly changing, slowly turning. First, let us go to the hope. What was this hope? The hope was that ITC would make a huge success of its FMCG business imminently. We thought it would happen over 3-4 years. Here we are, 3-4 years gone, and we have very little signs of that. The stock price kept going down because FIIs kept selling, and the company came up with only one response, that of giving a decent dividend. What happened then was dividend yield became the basis of investment. First, people thought that it would become an FMCG business. It would create an FMCG business large enough to be compared with another respectable FMCG multinational company. Then that seemed to be an endless pursuit. Then it became a dividend trade. Then it became a value investment because this company was trading at some 20 times while the rest of the FMCG was trading at 50, 60 or even higher multiple. So relatively it became very cheap, and people said, oh, this is so cheap, this has to go up. All this happened during a phase when inflation was coming down. If you are not able to grow your FMCG business in falling inflation, then rising inflation is going to make it doubly hard. It's like running when the wind is on your back versus running when you have a strong wind on your chest. Now you are going to be in a phase where the wind is going to be very strong on your chest. So the more experienced, the stronger business franchises themselves will struggle to grow volumes. In fact, there will be rampant down trading. Now, whether ITC will be able to capture some benefits from this down trading remains to be seen, because ITC is not known to be a cost efficient player. So that is something that is open for debate, and we need to only wait and watch and observe what happens. Now, in this whole trade, the most ignored part was that the cigarette business was the basic thing on which this whole company was running. All the money came from cigarettes, and cigarettes did not have any volume growth. In fact, volumes began to degrow, and only value growth was contributing to profits. Markets took a very adverse view of this, and research reports were always cautioning that this could get worse. Now, when you look back, all the predictions on ITC, whether it is FinTwit sourced, Twitter sourced, public sourced, which kept harping on the FMCG, or it was equity research sourced, industry sourced, and stockbroking sourced, which said that cigarettes may not do well. All these have gone wrong, and today you are at a position where cigarettes is again looking very promising. After they acquired a new CEO, after they recruited a new person, they are doing much better in cigarettes, and we could possibly see a volume surprise in cigarettes quarter on quarter. Pricing cigarettes has never been a great problem for ITC. Making profit in cigarette has never been a great problem. So today ITC is probably a buy in the eyes of both research and FIIs, simply because the cigarette business is doing well again. Ironically, my sense is that the FMCG business may start to lag and disappoint. So what were we doing for these 3 years? Harping day in and day out about the FMCG business. I am reminded of the Asia Motor story. The entire institutional investing was done in Asia Motors on the belief that Asia Motor will become a significant player in trucks. A decade later, that's not happened. On the contrary, the most unexpected part of Asia Motor, which was Royal Enfield, went on to become a great success story. Now nobody talks about trucks. Everybody talks about Royal Enfield. Many of the investors who made money in Asia Motors actually made it by luck, not because they had conviction on the right part of Asia Motors. They never had conviction on that. They never thought it would do well. What they thought never happened, and yet they made money, and they went to town crowing about how great their investment had turned out to be. Probably we'll have enough crows in ITC as well, but as a learning investor, you have to understand that being a crow doesn't make you a better investor. So you need to understand where you went wrong, what did not happen, what may not happen, and what is making the stock price move up. In that sense, ITC was a cigarette story, ITC is a cigarette story, and ITC will be a cigarette story. So you are investing in a cigarette story in which there are other distractions. Those distractions should not hurt the core story, and as long as they don't hurt the core story and the core story continues to grow, probably your valuations will be in a safe zone. So there is very limited utility in daydreaming that FMCG is going to become like, let's say, a Dabur or a Lever. It's not anytime soon that this is going to happen, and you need to be very wary of such daydreaming which is being sold to you. This in essence is what has happened in ITC, and this is what we must learn from the ITC experience. If people have loaded up their portfolio to almost 50% of their portfolio or even more of ITC during this rally, which I foresee in the next few weeks, you should limit your position in ITC and create space for other stocks which could deliver much better performance than ITC. Buying a cheap stock does not mean that you will make profits all the way until it becomes an expensive stock. That is the core lesson of ITC. Daydreaming and wishful thinking is not going to make our investing better, and when success comes from the most unexpected part of an investment, you should understand that it is not your thinking which has succeeded, it is coincidence which has worked in your favor. This is the core lesson from ITC, and I want you to take this away and make your investing better. Thank you for watching this video.